Okay, well, thanks again for your support of Tradex, and on behalf of our firm, I want to thank Tradex and all of you for what's been 21 years of partnership for us that we really value. It goes back a lot longer than I can remember, and it's a great partnership for the firm and for Tradex, and we really appreciate the opportunity to work on behalf of all of you to try and do the best job we can and earn your returns. And I think you'll see through the course of our presentation, one of the things that really makes this equity fund unique is we can bring a lot of different skills and tool sets to the table to try to navigate what is certainly a very challenging time for equity investors, for investors in any asset class, given the volatility we've seen, but particularly within the equity asset class. So I think we'll have an interesting evening tonight. And one of the other things I would mention to you is that the whole team, whenever Blair and the board are kind enough to say something quite positive about our performance when we do well for you, everybody on the team sits back down their desk and says, we got to do better. And so that's the kind of focus that is there, and every day there's that kind of focus on trying to make sure we can do the best possible job for you. So I'll keep moving along, and in setting the tone for tonight, something we try and keep in mind at our firm is thinking about a framework for investing. And perhaps the last 12 years has been as good example as you could see of having some kind of objective framework and how important it is to anchor back to that. And so when George Soros is speaking about the constant flux that we're seeing in the markets, and money is made by discounting the obvious and betting on the unexpected. And you think back over what we've seen in the past 12 years, and you can think about the obvious as being the top of the tech bubble, when all the good news was on the table and investors were pouring in. And when we all look back, we now recognize, boy, that was obvious. All the good news was built into those stocks. The valuations were fabulous. And then there again at the bottom of the credit crisis, when everybody was pouring out of the equity markets and running for the exits and heading for T-bills, which has been a fabulous trade ever since, but so have equities since the bottom of the market. We can all look back and say, gee, that was kind of obvious. Everybody had run to the other end of the boat. So how do you establish a framework? And one of the things I thought I'd do this evening is maybe just talk to you about some of the metrics that you can think about that we would mention to you from an overall equity market perspective that may be helpful to you. And it's the same kind of framework we tend to try to think about when we look at individual companies. So we think about sort of reasonable best case scenario, reasonable worst case scenario, and then try to develop expectations based on that relative to where the stock is. If it's trading towards the market sort of embedding worst case outcomes and some pretty bearish scenarios, there's probably some positive things that could happen and drive investors in the other direction. And likewise at the other end of the spectrum. So this is the way we tend to approach things. So when we think about the question that could be on many of your minds this year, the year 2001, 2007, 2008, it's fair to ask yourselves, why own stocks? It's been a roller coaster ride, particularly the last 12 years. The 1980s and the 1990s were wonderful times to own stocks, and it seemed like quite a stable and wonderful return. And then we've just gone through this period, and there's still a lot of conversation about the uncertainties that we're all facing, and that continuously is magnified into the stock market in a short perspective that we see day to day. So it's fair to ask ourselves, why own stocks? And this hopefully is a reasonable proxy of thinking about the pros and cons. And so the long-term setup we talked about the last couple of years, we felt it was reasonably compelling time to own equities. And the good news is when you've got growth, even though there's modest growth in the world, equities can participate. And what do I mean by that is, as much as fixed income is an important instrument in your portfolio, it doesn't participate in growth. And it has great deals of difficulty offsetting inflation. So particularly if the setup is as it is today with very low coupons. So stocks can participate in growth. Now, most of us aren't excited about the kind of growth we see today when you look at GDP, but corporate earnings growth has actually been quite strong, and it's come right back onto its long-term average, about compounding about 7%. Valuations, which we'll touch on in a second, we think are attractive. They're not as compelling as they were at the bottom of the credit crisis when all of us, had upset stomachs putting more money into the equity markets, but you knew that was the right way to go. But they still are pretty attractive from a long-term perspective, and we'll give you a sense of why. The yield is an important connotation. We'll give you a sense the dividends, as you're probably aware, in both Canada and the United States are substantially above 10-year yields on government bonds, and you get growth on your dividends. Dividends compound with growth. Inflation, as long as it's not really strong inflation, stocks benefit. As long as it's moderate inflation, the kind of inflation we're experiencing today, or a little higher inflation, that's a pretty good scenario for stocks, actually. And it's not as good for assets that have fixed coupons. And then there's always the opportunity to have some diversification. The bad news is what we've all experienced, which is all the extended periods of very unsettling volatility. And looking around the room, recognizing for a lot of you this is retirement money. Obviously, we wouldn't emphasize have all your money in stocks, but we think it's an important part of the portfolio to help fight inflation, help give you some sustainable growth in income, and just trying to stick with it through those severe times and add more if you can. So with that, we'll give you the perspective on valuation. So this chart you'll probably remember we talked about last year, and it hasn't actually changed that much. So the endpoint has come up just a touch higher, and just to make sure everybody's on the same page, what this chart is showing you, so it's the world equity market trailing price to earnings multiple. So when we go to buy anything, we want to think about, is this a really dear price that I'm being asked to pay, or is this a reasonable price? And a price to earnings multiple is a way to assess that in equity markets. And so when you look at the long course of history, many of you were probably investors in the 1970s and early 80s. There was a tough patch in the 1970s. Things were actually pretty attractively priced. And then there was this tremendous move in the equity markets, and prices got pretty dear. And they got up over 30 times in terms of the price to earnings multiple. And the major part of the pain we've experienced over the past 12 years has been things were just too expensive, and we've continued to have compression. So prices have come down to levels that we think are reasonably attractive. And if you look at the long line, it's telling what the long-term average is. So that's not saying that's always buy below that line, but that's saying, geez, we're getting on the reasonable side. And then look at the setup again. You see back in the 80s, we all remember what was going on then. Tremendous inflation, very high interest rates. Those are real headwinds for equity returns. When you have really, really high inflation and interest rates today, we have this Goldilocks backdrop. So the unsettling part that's probably keeping valuations from climbing higher faster, we all know that there's still some systemic risks in the world. So the backdrop we think is quite constructive when you think about reasonable valuations, low interest rates, low inflation. And with that, we'll turn to the next chart. And so then it's fair to say, so what could equities compound at over time? Well, interestingly, over very long term, as far back as data goes, equity returns all in, so total returns including dividends, have compounded at about 7%. And usually your setup to get close to that is when you've got valuations on your side, so they're average to below average. And one of the ways to think about what is the price to earnings multiple you just showed me, what does that mean relative to bonds or other instruments I can look at? Well, if we actually do it the other way, think about the way yield works. So yield is just what's the income I earn on the price I paid. So turn the PE around, and basically the inverse is earnings over price. And so we compare that, which is the blue line, to what you're getting in terms of the fixed income markets today. And the reason why we're excited about the potential for equity returns last year, and we still are today, is because we think we're getting a much better deal in equities. And the interesting thing is that in addition to that, the gray line is giving you the dividend yield. And today you're getting paid to take some of that risk with a better income than you are in fixed income. We have a lot of fixed income exposure in the firm, and to our clients, and it's a great asset class, and it's important in the portfolio. But we do tend to think that the setup from an asset mix perspective is better for equities, and then obviously subject to each individual's age and risk tolerance and all those good things. But this is one of the reasons why, and it gives you some sense. I think we just lost the AV. it gives you some sense too for a reasonable proxy to think about, well, how quickly could my stock portfolio compound? So if you're thinking on the fixed income side, a reasonable proxy has been, what's your yield? That would tend to be most of the time a good proxy for what your forward returns would be. The last few years has been far better than that. We've seen yields go down. In the equity side too, the earnings yield is a reasonable proxy for that. So that was about 7%. And when we get the AV working again, we'll give you another snapshot just in terms of risk reward that gives you some reasonable feeling for that. Oh, did it? Okay, so we can keep going. Okay, so I'm now on slide 7, so we'll just keep on going. So this is when we think about a framework from a stock standpoint. This is a simplified version of what we do. We think about a variety of scenarios for the earnings. We think about optimistic scenarios. We think about pessimistic scenarios. We think about the drivers that would take us in either direction, and then we think about the valuations that stocks could trade at given those various scenarios for the earnings outcomes. And so you've got, in this particular case, we're looking at the S&P 500, and so we'll wait till we're forward there. So we're looking at the S&P 500 earnings consensus. There's a earnings expectation for the S&P 500. If you take all the estimates for the individual companies and boil it up, you get an expectation for the S&P 500. So just trying to give you a framework for where we are with equities today in terms of what the scenarios might mean. So you've got earnings on the left-hand side of the matrix, and then you've got the valuation those earnings might trade at on the top. And this is not every scenario, but this is a reasonable framework. And so what you can see, we've circled 1590, so we're sort of in that zone. We've been tending to trade there to slightly less than there recently. And so if you look at that, that's essentially building in a fairly average valuation on expected earnings. And what we could do then is bookmark the pessimistic scenario and say, well, what happens if you go to the pessimistic scenario and you get 5% earnings growth, which is a couple points below what earnings tend to grow at over time. They tend to grow at about 7%. And you trade at sort of an average multiple, a little below average of 14 times. What would my total return look like? Well, it would be about 5.5%. So that's from here what we think over a longer haul what a pessimistic outcome is for equity returns. If you get something that's a little more normal, so you trade at an average valuation of 15 times and you get that 7% earnings growth from here, then you could actually produce about a 10% annualized rate of return, total return. So it's a reasonable way to think about, what should equities over the long haul achieve. Now the other question we get, if we can just advance this slide, often is well, okay, that sounds good, but how do I time it? For some, they're very fortunate and they buy at the bottom, or something happens that allows them to buy at the bottom, and they always buy at the bottom, and others are unfortunate they hit it at the top, and that causes scar tissue, and so we all look back and we say, geez, if I could have timed it just perfectly, whether it's houses, cars, stocks, everything would be roses. Well, in this little cartoon maybe captures something that we were speaking about at the outset, really, in terms of philosophy. I mean, timing can be very, very difficult from a short-term perspective in the markets, but certainly one thing you can say looking back over time is if you follow the wisdom of crowds, you're really getting yourself into trouble. So if you're thinking over the long haul, then you probably wanted to have a disciplined process of continuing to bang away, and whether it's equities or other asset classes. But if you also just pay attention to these spikes we see in pessimism, that's usually a time whether it's a massive spike or sort of a short-term spike along the road to maybe buy a little more. And hopefully over the long haul, this really bumpy stuff that we see gets smoothed out, and you have an experience. So this is since PH&N started working with Tradex 21 years ago. The annualized total rate of return, including the income, is about 7.7%. So it's a little better than the long-term average from stocks. And that looks like a hell of a smooth ride, and it certainly wasn't. But the nice thing is it's sort of like a curvy road. If you look way back from the mountaintop after you've been on a curvy road, it looks a lot straighter. And so if you stick with it, hopefully that's what we'll see down the road as well. In terms of the market context, and give you some update on performance, what you're going to see here is that the TSX, after having tremendous performance in most years when equities were good over the past decade and change, and is sort of a leader on the scoreboard, is been stuck in a more lagging position. That really started in 2011, and again we saw it in 2012. So you can see here the TSX was trailing the Nikkei, which has been finally coming back to life after a couple of decades, but more of the points been trailing U.S. equity returns, has been trailing the EFI, which is Europe, Asia, and the Far East. So here we are, and we're finding ourselves in company we don't like to keep, more towards the bottom of the list. And what's doing that? Well, if you look at the right-hand side, this is the breaking down the 10 sectors in the TSX. And what you're seeing here is there have been some fabulous returns earned in areas such as healthcare, which you have exposure to through a couple of companies, one named Valiant and one called Catamaran. There's been some fabulous returns in industrials. A big driver of that has been the big railways, so CP Rail and CN Rail, that have played a part in your portfolio. And these other sectors, and they've actually had tremendous returns just like their brethren in other markets around the world. What's held us back is that we have such high exposure to energy materials in Canada, which tend to make up about 45% of our equity market. And those two areas have had miserable returns relative to what you've seen out of areas like the S&P 500, and particularly in materials. So that's the base metal companies, that's the gold companies. And in fact, what we've seen over the last couple of years in terms of the setback in that sector is equivalent to the sell-off that sector experienced in the credit crisis. So it's been a really tough part of the market, and it's a much bigger exposure for Canada than it is other markets. And we'll touch back on that. So if we touch on returns, so there's a number of somewhat telling observations here. The past year, the fund has enjoyed a return that's been better than the TSX, and part of the reason for that has been there's been some good stock picking in the Canadian side of the portfolio, but the other reason is because we enjoy some latitude to take on U.S. exposure in the portfolio. And so if you will, sort of the average experience should be about 25% U.S. exposure. When the Canadian markets were doing particularly well, we were underweight U.S. We had more than the average Canadian exposure, so we tended to be 80% or more Canadian exposure. Now we're overweight U.S., and we've been shifting in that direction consistently since 2011. So having that exposure to the U.S. returns has helped us elevate returns over and above the TSX. Another comment I'd make, though, consistent with what we've been talking about, is you can see this bumpy ride in terms of when you look at the annualized return. So the 1 year at 7% feels decent. All of us would always love to see the double-digit returns that the S&P 500 produced. The 3 year, okay, 4.5, nothing to write home about, but better than inflation. And then the 4 year return, 13.3, pretty good. Now, the 4 year return had the benefit of being, if you think back 4 years, you were basically at the bottom of the credit crisis. But interesting to note now, 5 years, that includes all of the damage that was done in 2008. So the second worst sell-off of all time, going back to the Great Depression. And here we are 5 years later. Probably nobody would have guessed, considering all the bearishness that was there at the time, that you'd actually have a positive return when you look back over 5 years. So there's a number of stories here. And certainly we look at our own scorecard, and we like, that we're generally doing a decent job beating the market. We don't like that we still got to dig out on the 5 year number, and we're going to do our damnedest to make sure we do, and continue to outperform against the index. And the great thing is we've got a bunch of tools to continue to utilize to do that. So with that, I'll touch on the macro environment that you've probably heard a fair bit on, but I think just from an equity standpoint, thanks. Just from an equity standpoint, I'll touch on a couple of things. So we've had this fabulous recovery in stocks, and in many ways it started last summer when the headlines were just as ugly as they were in prior periods where we've seen stocks sell off. So it confounded many, and what we have seen, there was so much risk embedded in the stock market in terms of concern, and stocks have been so out of favor even as they've been climbing this wall of worry, that a sniff of good news around the potential that all the systemic risk we're all aware of in the world is receding created some improvement in valuation. That was the first thing that really helped drive equities. The second thing was the economic environment in the U.S. and some other areas, but particularly the U.S. was improving. And whether you look at these factors here, or you think about what's happened on household debt and the affordability that we've got in terms of the financing in the U.S., and the bank lending channel is up and running again, employment's doing better. A lot of things have been much more positive in the U.S., so there's been this slow progress that's really helpful. A moderate growth environment where we're progressing forward and the risks, some of the risks are falling off the table, is good for equities. There are hotspots that you're well aware of, and potential things that will cause some upsets down the road, like the U.S. debt ceiling, and some interesting places to watch, like the Japanese putting their foot to the floor, and the Chinese transition in leadership, where they're now clamping down in areas like housing. So there's always room to talk about a bearish story or a negative story for equities, but we think overall, right now, we'll continue to climb the wall of worry, and we'll still continue to make modest steps forward, maybe 2 steps forward, 1 step back. And then with that, I want to talk about Canada for a moment, because what you're seeing in Canada is a little bit different picture than the U.S. You could say that the picture in the U.S. would, if you looked out over the next couple of years, the expectation would be, given all the underlying positives, although many of us have gotten so used to a lot of negative things happening in the U.S., maybe that's hard to see or believe, but there are some underlying positive and constructive forces at work in the U.S. economy. So it's progressing in terms of the expectation for growth, whereas Canada, which we all do feel day to day, is decelerating. And there's a variety of factors for this we can all relate to. We've had a tremendous housing environment, and we've helped fuel that with household debt. So now it's time to pay some of those bills, and things are slowing down a bit. Another factor is, if we go to the next slide, is certainly we're seeing an area that's been a tailwind for Canadian stocks is now becoming a headwind. And so what this chart is just showing you is it's showing you the price return, or the price change, in various commodities that are key to the Toronto Stock Exchange over each of these years. And you can see in sort of in 2009, 10, most of it was good news. And then as we started to underperform a U.S. equity market in 2011, 2012, you can see there was some damage done in a few key spots. And that continues this year. So there's a headwind in a key component of the TSX, so we're certainly aware of that. The crude oil price, you also want to be aware here. So this is the North American crude oil price, about $88. And yet in Alberta, they're often only receiving 40 to 50% discount to that, because there's so much energy now being found in North America, so many hydrocarbons, and we find ourselves at the wrong end of the pipeline. So the sewer's essentially full by the time we start trying to fill. And so there's this excess supply, so the only way they're taking ours is the discount, or things that are costly, like transporting it through rail. So we're not receiving that, so that's unfortunately a headwind for our companies. And then natural gas is one of the few bright lights. So what have we been doing about this? Well, on the next slide, you'll see what I was mentioning is that we felt we were starting to see some of these green shoots take root in the U.S. So we've been moving from being underweight U.S. exposure to being overweight U.S. exposure in the portfolio, and that has been a key factor in helping lift returns over and above the more paltry returns the TSX is now returning. So the shift in the emphasis was reasonably well timed. That said, in hindsight, we wish we had done even more. We've got more latitude, we can go much further, and had we known what we know now, would have been even more aggressive out of the gates in terms of that move. But certainly, that's the direction we're headed, and it's a unique mandate that allows us to do that, and we're seeing lots of opportunity. Another slide that I think will get this across is worth thinking about. As Canadians, given the past 12 years, it's been good to have money at home. As tough as it's been in equities, it's been a better experience in Canada since the tech bubble than it has been to have money in overseas markets or money in the U.S. market, and that's been accentuated by the strength of the Canadian dollar, which robs some of those returns for those of you that had unhedged exposure into places like Europe and the United States. So with that comfort, it's always easy to extrapolate that into the future and to assume that'll be the continued theme going forward. One of the slides that we like to put up just to make sure we try to balance perspective for everyone and for ourselves is thinking about the TSX performance and underperformance relative to world equity markets. Actually, if you can go back to that slide. So what this line is showing you is if you take the price return of our market and divide it by the world equity market, that's the line you're getting. So what does that mean? Well, when it's going up, our equity market, our stocks are outperforming. When it's going down, the world stocks are outperforming. And you see these long cycles. So these cycles tend to, not surprisingly, coincide with whether you're in a resource boom or not. And so if you think back to the 70s, when I was growing up, we were experiencing more of a resource boom. The Canadian market tremendously outperformed. And then we went through that period of tremendous innovation in the United States, and we had a strong global equity market that was well diversified, wasn't reliant on resources for the most part. And so the Canadian stocks really underperformed, and for almost 2 decades. And then we had this period of 13 years. We enjoyed fabulous outperformance. And here we are today, starting to derail on that. So we, although we think there's tremendous companies in Canada, tremendous opportunities to create returns, we do think it's going to be a little bit tougher period to see how Canada will outperform to the degree it has in the past. And we certainly are looking to the exposure in the US as being a key ingredient in this portfolio. And if you flip to the next slide, you'll just see that there's difference in balance. So in the Canadian market, you can see in the bottom area there, energy and materials, and financials for that matter, very big components of the market, but resources are really, really important component of the market. Right now they're down just a touch over 40%, but they nearly touch 50% at the peak for resources. And you can see the composition of the US market and how much better balanced it is. So for each dollar we put into the US market, it gets a little better diversified in terms of where the growth is coming from in the economy currently. And with that, I want to touch on another lever that we're fortunate to have in this portfolio and has been working well, and that is the ability to tactically manage currency. One of the fears that many of us could confront, considering how much volatility we've seen in currencies, is, well, what about if you buy US stocks, then geez, I got that exposure to the US dollar. That wasn't a good experience the last few years. So we do manage the currency, and we have a program to manage that currency exposure. The neutral position is about 50% exposure to the US dollar. Right now, over the right-hand side, don't really have to focus on the meaning of that chart to a great degree, but what it's telling you with the US dollar minus 9% is we think the US dollar is undervalued. So we do think the US dollar is going to appreciate against Canada. So while we're increasing exposure to the US, we tend to not be fully at our 50% hedge. We tend to be taking more exposure to the US dollar as well, and that's been working for the portfolio. A team, thankfully, has had a tremendous batting average through good periods and bad periods for the Canadian dollar in terms of managing the exposure we have in currencies. So with that, I'll just take you into a couple of thoughts on the portfolio. First off, I just thought I'd remind you on the team, one of the things we do enjoy is a tremendous depth of resources. So it's not only your portfolio managers, but we have, as far as we understand, the most extensive team in terms of sector analysts focused day-to-day on the ground in companies. This is just the team leaders that you're seeing when you see the sector portfolio managers. And each of those sector portfolio managers are award-winning fund managers in particular sectors such as Chris Beer in gold and precious metals. Underneath them, there are teams of people working and scouring the market, so we benefit from that. We also benefit from utilizing areas such as foreign exchange to help bring an additional tool to the portfolio. And then finally on the trading side, I'll just touch there, and we're fortunate to be the largest traders on the TSX, so that gives us a very good position to benefit from good flows and information that we can help put to work in the portfolio. The focus we try to take day to day, in the next slide, is we have a growth orientation. We want to have companies that we think are trading at a reasonable price but growing their earnings faster than companies generating the market. We want to identify companies from a bottom-up perspective. So we're utilizing some of the tools from a top-down, meaning thinking about U.S. exposure versus Canada exposure. But when it gets into picking stocks, we're not trying to pick sectors. We're really trying to go right to the ground and think about focusing on industry leaders that we think are utilizing their capital and investing it at really attractive, for really attractive returns. And we want to focus on companies that we think have some attractive tailwinds in terms of growth. And with that, I'll turn to the next slide. And a few things that are interesting about your portfolio beyond what we've talked about. So some of these key characteristics in terms of certainly what we're looking for in terms of sustainable competitive advantages and reinvesting cash flow accretively. But in addition to that, what we're looking to do is think about having sources of differentiation, some early stage growth opportunities in the portfolio combined with very attractive stalwarts that we think are growing and reinvesting capital very attractively in both Canada and the US. And so on slide 25, I've done this before, and you've seen that, you know, your top 10 holdings, Jay, if you look at that versus most other Canadian equity funds, looks pretty similar. These are mostly household names. Well, these are amongst the household names that we think are the most attractive in terms of the potential to build value for investors faster than other companies at any given point in time. But below the surface, this next slide, which we talked about last year, and you know, when we look at things that are really having impact and really moving in the portfolio, you can see that a number of these companies aren't necessarily household names. And we'll talk about a couple of them. We'll start with a household name in terms of Canadian Pacific, but there's been, under the surface, there's a number of holdings in the portfolio that are you know, not names that necessarily are well known. So with that, we'll touch on Canadian Pacific. So one of these companies that was a great performer for the portfolio, has been in the headlines, is a stalwart Canadian company. And the reason why we liked it is the reason why it seems that the market has fallen in love with it now, and that is that there was a tremendous opportunity to cut costs and rationalize a great business and ultimately bring much better returns in terms of earnings to shareholders and get that through the bottom line. And so you've seen a change in the CEO, and that's really helps establish the company on a better growth pattern for earnings. That has been well recognized. So thinking about that framework we first started with, whether it's the Soros quote or when we were talking about reward to risk in the US equity market, right now we're trimming because we think it's well recognized. So the obvious, if you will, is being well discounted into the stock. Stay tuned. This will be in the portfolio again, I would expect, but we'd prefer to see it stumble either in terms of the market falling in love with it as it is right now, and so getting a bit of a setback in that, or maybe a little bit of an earnings stumble and we get an opportunity to add it back at a more attractive valuation. Another company I thought I'd highlight that is generally a little bit below the radar is Element Financial. And so one of the opportunities we have is we can see companies very early stage when they're still private and get to know them and take a position. And Element Financial is an interesting company because it's engaged in a niche, and it's equipment leasing. And this is an area that has had challenges before because they were borrowing short and lending long, essentially. When you lend out to somebody who's buying a piece of equipment like an airplane or train or whatever, they tend to be buying that for the long haul. And where this industry has run aground has been when they borrow to do that short, and then they run into something like the credit crisis and they can't borrow anymore, and they were lending long. So that's a real mismatch. What they've done now is the financial company, or Element Financial, has agreements with the life insurance companies that are long lenders, and they do lend over the long haul. So that gives them a stable base to lend from in order to allow their clients to make equipment purchases. And so this has been a very experienced management team, and that has been taking this company into a very interesting growth position in North America. So that's in the portfolio, not a household name. Within the resource area, on the next slide, I just want to give you a flavor. So if the resource area is going to be particularly challenging, and whether it be in the environment we're in or at any particular period in time, it's always tough to predict commodity prices. What we're constantly trying to look for is companies that are growing their reserves per share, growing their production per share, a lot of growing their cash flow per share. So the great financial metrics you'd expect us to be looking for and trying to identify those companies early. There's a lot of companies engaged in the resource business that go out and buy mines or buy oil wells and ultimately end up diluting the value for their shareholders because they end up with less and less reserves or less production per share. So we're trying to identify companies like Tourmaline. And so the portfolio tends to have a combination, for example, in energy, of some industry stalwarts that we think are very attractive and allocating capital effectively or very attractively priced from a risk-reward perspective, and then some up-and-comers that we think are even more attractive in terms of the growth profile on a per-share basis. So that's Canada. Into the U.S., you can just see your top 10 holdings. And this is a fairly concentrated portfolio we have in the U.S. It's got a growth orientation as well, but it's 35 to 45 holdings, so it's reasonably concentrated. As a result, it tends to have a lot of very strong companies that we think have attractive growth characteristics. And so many of these companies will be well known to you. One of the key things we're looking for is the opportunity to buy growth at a reasonable price. So an area of emphasis for us is on the next slide. And this is an area of emphasis for us that's been a headwind. And what this shows you is that we've been overweight information technology companies. And the reason for that is on the left-hand side, you're seeing something we talked about earlier on, which is basically the tech bubble. And we've had this tremendous valuation compression, particularly in the information technology sector since then and since 2006 on. And so you can see even back in 2007, if you look at the bottom table, price-to-earnings ratios were 20 or in some cases over 30 times in this sector, and they had virtually no dividend yield. Today we're seeing market-like multiples, reasonable multiples. So on the right-hand side you can see what we're seeing, and that's because we've been seeing this steady earnings growth, and now these are dividend payers. So this hasn't been a rewarding position for a U.S. portfolio as yet, but we're excited about it because of the obvious opportunity to own some great businesses that have really been generating attractive and steady earnings growth and are now paying more and more in terms of dividends.